Hey guys, welcome back to the channel. My name is Dave. This is Wealth Adventures, where we talk about wealth. And today we're talking about a type of option called LEAPS, right? Long-term equity anticipation securities. I know it sounds like a mouthful, really not too hard, especially if you already understand buying and selling puts and calls. So I want to talk about when you might use these, when you might avoid them, how I've got a situation right now where I might be able to utilize one. So if that's what you're looking for, please stick around. Whoop! First off, and I think this has to be said, is LEAPS, L-E-A-P-S. You're not going to say LEAPS options. You're not going to say LEAP options. I don't know. It's a mess. But long-term equity anticipation security. So LEAPS, if I put that up here, somewhere they got anticipation in there. So we should really call the acronym police at this point because that's a mess. But I understand. We're leaping forward, essentially. So when we talk about this, we're going to understand what these are because we're leaping forward. So what is a LEAP? Well, if you're familiar with buying and selling puts and calls, this is not going to be a hard thing to grasp because all we're doing now is we're leaping out a long way into the future. I guess that's where they come up with leaps, right? We're leaping forward into the future. So instead of something expiring in 1, 2, 3, 4, 5, 6 weeks, I've got a lot of stuff expiring October 15th that I bought a month or so ago. But typically I'm out 3 or 4 weeks. But with the leaps, we're buying out 1 year, 2 years, 3 years even. So you're buying leaps way out into the future, and that's the whole idea. It's still the same put or call that you're buying or selling. You're just buying it way out in the future. 1 year, 2 year, 3 years away, and that changes things a little bit. That's what we're going to talk about. One other item of note before you jump into this too far is I think you should understand buying and selling puts and calls pretty darn well before you jump into leaps. I mean, leaps are just with a longer expiration. It's buying and selling puts and calls, a longer expiration. The whole video has just been summarized, but if you understand that basic material, and I'll link a video above that you can go watch and kind of get a better understanding before jumping into this, it will help you quite a bit as we go through this information. One of the biggest advantages that I see when I think about leaps is the fact that I get 12, 24, 36 months to determine whether I think a stock is bullish or bearish. So let's use an example of Apple, okay, which is about $140 a share right now. And if you told me what's going to happen with Apple in the next, I don't know, 1 to 3 months, I would say, I don't know. And that's why I like to sell puts and calls on Apple. I'm not typically buying puts and calls because I don't know what's going to happen over the next few months. But if you gave me 12, 24, 36 months, now I think I can maybe predict it, right? I feel pretty good. I'm bullish on Apple, feel good about it. 36 months from now, it's going to be worth more than $140 a share. That's my prediction. I feel pretty confident about that. So I could go buy the stock, but if I can use leaps, then guess what happens? I get to leverage my money more, right? Because if I go out and buy 100 shares of Apple, it's going to cost me $14,000, right? But if I go out and I buy a leap option out 24 months from now or 36 months from now, it's going to cost me a lot less. So I'm leveraging my money because I still have control of 100 shares of Apple stock. So that's probably the biggest advantage because now it opens up puts and calls to a guy like me who typically wouldn't do that on the short term. But on the long term, I might be able to find a few stocks out there that I feel really confident in over the next 12, 24, 36 months. Does that make sense? Another nice advantage of leaps is as a long-term hedge. So let's say you've got a particular stock that's grown substantially. Again, let's say you bought Apple 10 years ago and it's worth $140 a share now, but you still think there's some good downside that could happen over the next 12 or 24 months. Well, you could use leap option as downside protection, right? So you could buy a put at $130 a share to protect your downside over the next 12 months as bad information is coming out. And I'm not saying use this again with Apple. It could be any stock that you like, but something that maybe you really like and you love the growth and you're willing to give up some of that growth to protect your downside. You could use a leap as a hedge over the next year or 2 years if there's rough waters ahead. Another nice thing about leaps is that they can qualify for long-term capital gains if controlled properly. So see your tax advisor when it comes to this. But basically, if you hold it for 1 year and 1 day, and then you sold to close the position, for example, then it should be a long-term capital gain. But do some research, make sure you understand it, and it's really clear when you're buying and selling these and when the actual taxable event occurs. That's the tricky part. Look for the taxable event. All right, so let's talk a little bit about the disadvantages of leaps. And, anytime we're talking about options, the first thing I'm going to throw out there is you can lose it all, right? So if you buy a call option that's out 1 or 2 years, and you let this thing start ticking away, and it starts moving in the wrong direction, and you're steadfast that it's going to come back, there is an expiration. Now with stock, if I buy McDonald's now and in 2 years it's gone down, I can feel like I can buy some more McDonald's. But you can't do that with LEAPS. So there's that risk, right? You get into this. So I would say the biggest disadvantage is only invest what you can afford to lose. I'm not your financial advisor, but this is just a general statement. These things are risky, right? So you have to be willing to lose everything that you put into a LEAP. Another little disadvantage is just the cost of LEAPS. Now, if you're a seller, all the more power to you. If you're going to sell something out 1 year from now and you're selling calls and puts like we like to do sometimes, well, you're going to be able to collect larger premiums. People get really excited. It's all that extra time value way out there. Anything could happen. That's why you're getting that extra premium. But on the other side, if you are a buyer of calls and puts and you're used to buying out 1 or 2 months, well, you're not going to find it that it costs you the same amount. Buying one out 1 year or 2 years from now is going to cost you a lot more premium upfront payment when you go to buy that call or put. So disadvantage in the fact that you're going to have a bigger cash outlay up front. So LEAPS are a fun long-term instrument that you can use to do a variety of things. I really like them. I like to shop around. I like to think about how I could sell puts and calls with LEAPS. Again, I tend to be a seller and not a buyer, but it does give me the opportunity to kind of zoom into that buying position because it gives me all that extra time value that I can utilize and see if it makes sense to buy a LEAPS. And now, I'm in a particular situation here where I have a potential use for a LEAP, and we're going to take a look at that now. Again, I said LEAP. I mean LEAPS. Anyway, one other factor, you might not always find LEAPS available for every stock that you like to trade. Sometimes you will not find them for small caps that you're used to trading options against, but they don't offer LEAPS. So just keep that in mind. Microsoft, Amazon, Apple, you will find them. ETFs, big ETFs like that, you might find them. So it's just up to you, but just keep that in mind as we go through this. Okay, so here's the situation that I mentioned. I've been accumulating Alibaba as it's been dropping. So whatever your belief in Alibaba is, whether you think it's the next Amazon or is Amazon over in China, and you think it's ready for takeoff and it's going to $400 or $500 a share, or if you think this thing's going in the toilet because it's a Chinese stock and it's highly regulated and it's an ADR and you have all this other information on it and you just think it's going to go down. I've accumulated a lot through selling puts. So my situation is I've got about an average buy price at about $220 a share. I've got about 1,000 shares, so I'm underwater on this one. Things aren't always rosy as they seem, but I set up a trade here, right, just to kind of run through this and we can kind of play with it and see where it goes. But kind of wanted to illustrate how maybe we might utilize a LEAPS. So the first thing you'll notice with this particular trade is this is Alibaba, a put, where I've got it set up to buy to open 10, August 20th, which is just the next expiration date that's coming up. That's this coming Friday at a very close $185 strike price. A put, right? It's going to cost about $2 per contract. All right, so with 10 contracts, we're looking at about $2,000 to execute this trade, this full insurance buying a put. Now, if we wanted to look at this and say, what's the effect of time on this particular transaction? Well, we take this August 20th and we make it into a LEAP and we go all the way out to, let's say, September 16th. So about 13 months from now. We say September 16th, boom, our trade suddenly becomes a $30,000 transaction, right? And you're seeing that. And that's only due to time, right? There is no intrinsic value. It's just extrinsic value. Implied volatility, yes. But time value, that's the big part here. It's the time value, adding those 13 months. Those 13 months cost you $30,000, or basically a difference between 29,000 and 2,000. So almost $27,000 of time value. Some of that obviously is implied volatility, but the great big thing here is that time that goes out for 13 months. And that's why if you are selling these and you're accumulating a bunch of money, that $30,000 or that $27,000 in this situation, that is yours to keep because of that time that you're willing to provide in this trade. My personal feeling with Alibaba is that it's going to go somewhere. It's not going to go and stay at $188 a share. I feel like more bad news could come out and that this stock could go to $130 a share. I also think that this stock is a coiled spring that's ready to explode and could go to $500 a share before 2022 ends. So those are the two situations that I see with this particular stock. And I don't know which way it's going to go. So what are my options here? What can I do? Well, I can sell right now and just get out of the way. And that's what a lot of big funds are doing right now. And one of the reasons the stock is correcting so much is because people aren't sure, and they want to protect their money. So that's one option. I could sell and take my loss, take my lumps and get out of the way. Or, I could buy some downside protection. So that's what we're going to look at now. And if I wanted to buy full coverage insurance that we've talked about when we're doing this, how long out should I go? Well, this isn't something that I think is going to be settled over the next 1 to 2 months. This might take a full year. And that's why I picked 1 year from now, where hopefully all these things have kind of come to pass and we realize that, okay, the stock is safe or it's not safe. So I could see this going down and getting thumped over the next 6 to 12 months, or I could see it really taking off once some of this information is figured out and everybody starts flocking back to Alibaba. So for me, if we adjust this for my full coverage insurance, well, my average buy price was what? About $220 a share. I popped that in there, and I no longer want it for August 20th. But if you look at this right now, the reason that this changed again to about $32,000 is all we did by changing that, because this is a question I get a lot too, is now we've added a ton of intrinsic value, right? Because we are very in the money on this put now. So that's why it goes up, because you're basically buying $20, $30, $2, 188 or 220 minus 188. You're buying that much worth of intrinsic value, and that's flocking right into our estimated total cost down here. But for me, obviously, I'm not doing this for August 20th. I need some long-term protection. So we're going back to that 13-month, September 16th of 2022. And boy, oh boy, will this cost a lot. This will cost me $50,000 to protect my 1,000 shares at $220, which is about my average price. So if I wanted to right now, I could spend my $50,000 and give it to the seller over there on the other side and shake hands, smile, and say, here's your $50,000. I am now fully protected on my shares. But what does that really mean? I'm buying protection. I'm buying insurance, right? He's handing me a policy. For $50,000, he's giving me a policy. So for every dollar underneath $220 a share, right, I get to basically close this thing out no matter how low it goes over the next 13 months, right? I can close it out at any time, or I can let it go all the way to expiration. So if in 13 months from now, Alibaba's really gone in the toilet and it's gone all the way down to $10 a share, it doesn't matter to me because I get to sell it at $220 a share at the end of all that. So for $50,000, I get full protection, right? It cost me $50,000. I'm going to get to sell my shares, the original purchase value, but it cost me 50 grand, right? So I'm basically saying I'm willing to lose up to $50,000 on this, which is basically a price of 170. So it's like me buying it 220 and being willing to sell it at 170. So would you take that? I don't have my answer yet. I'm not sure. I haven't decided if this is a good bet or not. Because as crazy as Alibaba is, do I think it could go down below 170, below 160, below 150? Yes, I already said that. I think it could. It definitely could go down there. Could also go flying through the roof. So let's look at the other side of this trade. What if the other side happens? What if it starts to climb back up? And I don't think it's going to climb back up just to 200, 210, 220. If this thing takes off, I think it could go through the roof. Like I said, $200, $300, $400 a share. So then I have to look at my other side. I'm giving up $50,000 and my average price was $220. So if it does start to climb, now I need to go back the other direction. It needs to go all the way up to about $270 a share to make back my $50,000 investment. So it would by break even on the upside, right, is about $270 a share. So this goes all the way up to 270, then I'm break even. And I can sell, I can get out of this, or I can do whatever I want to do, lighten the load. Or if I feel good at that point, I can just write it out, right? Or I can sell it at any point above there and start making money. So that's really the determining factor here. And this is where this one might actually make sense, as crazy as a number that is. I've got a lot invested into Alibaba, and to protect it, it would cost me $50,000. But at 188, when I purchased it at 220, I'm already down about what, $32,000. So we're not too far from my $50,000 number already. So it just depends on the volatility of the stock moving one direction or the other and whether I should do this. For you right now, I can't tell you. If I do execute this trade, I will definitely list it down below. But, just something to knock around when we're looking at leaps. We're looking at reasons to utilize these types of products, right? It's not just a gamble. It's not just throwing our money away. We're trying to look for actual utility. And one last thought on this. The reason that I bring leaps into this particular trade is because it's going to take that amount of time to actually figure out what's going on with Alibaba. Between China and US and everything that's going on, I don't think it's something that's going to be cleared up in the next 30, 60, or 90 days. I think it's going to take a full year to figure out, and that's why a leap becomes so valuable in this, to see, wow, this thing won't play out. All right, so that's a little bit of a practical example of how you might use a leaps with an S option. But, I think Alibaba is just kind of a strange one. It's kind of one that got its hooks in me. I think it is truly undervalued, but we'll have to see if people can figure this stuff out and if the price is going to come back or not. I would never suggest anybody jump into Alibaba right now. It is a pretty risky one to be in. So we will see how it plays out. If you guys enjoy this content, please consider to like and subscribe to the channel. We'll have more stuff coming out, whether it's on options, wealth building, all those great things that you need to know about. And hopefully it's not just about how to reduce your losses when you get slammed in the face by Alibaba stock. But either way, that's what we're here for. So if you have questions on any of this stuff, please just ask down below. I really appreciate you watching. Have a great night. Take care. Whoop.